See it, click it, trade it. Join the club. Tastytrade.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
The beauty of Thinkorswim was that we were different.
From the name to the front-end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
You can get up to $4,000 when you open and fund a new account with Tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade. Make your move.
Oh, yeah. Tasty Nation, good morning.
You know you need it. Got to know.
We built Tastytrade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tastytrade.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
You can get up to $4,000 when you open and fund a new account with Tastytrade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tastytrade. Make your move.
If you missed the live show, here's our cherry on top weekly recap. Look where I'm sitting today.
Crying out loud. You big dog, you.
I hope I've had my tetanus and hepatitis shots.
I was driving home.
Yes.
Pouring rain. I
Yes.
stopped somewhere in Bucktown, and I got drenched.
Oh, no.
I know. Not happy.
No.
And then,
Did your extensions get wet?
what'd you cook?
Pasta with a lemon zest cream sauce.
Lemon cream sauce? Would you put cream in there, or would you put milk? What do you put?
He puts.
Whipping.
He does more of a butter.
I did whipping cream.
You should use cottage cheese.
I already eat too much cottage
I'd rather do ricotta cheese.
You eat cottage cheese?
every day.
Oh my God, please tell me you don't eat cottage cheese with cling peaches?
I do. I love cottage cheese.
Oh my God, how old are you?
In LA, I don't know where I'm going to dinner on Saturday night.
So how do you know what clothes to bring? Like if you don't know where you're going to eat?
Oh, wait a minute. You gotta be kidding me. You think there's an attire, an outfit for where he's going? He's wearing what he wears on a plane. He's wearing what he wears to the show.
Wait, it's still pool weather out there. You bringing a bathing suit?
I might go in the hot tub if there's a hot tub.
So are you, well, how are you gonna go in the hot tub?
Bathing suit. Do you wear that under the pants on the plane? That would be good.
Over these days. Yeah, all the kids are doing it. Pearl necklace and over the pants.
Get the full scoop by checking out the archives at tastylive.com.
Are you on a quest for trading enlightenment? Driven by an unquenchable need to find the twin flame to your chosen strategy?
Our Where's Bat Live event is the search for trading's ultimate holy grail.
Do you have what it takes to find the elusive bat as we visit 3 cities?
Join 6 Tasty Live speakers
as they present 6 unique strategies
and 6 unique clues using games and probability
to lead to the ultimate prize. Sign up for this free event today at tastylive.com/events.
Look who's back testing. Tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tastytrade.
The beauty of Thinkorswim was that we were different.
From the name to the front end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
You can get up to $4,000 when you open and fund a new account with Tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tastytrade, make your move.
Oh, yeah. Tasty Nation, good morning.
You know you need it. Got to know.
We built Tastytrade's web platform for today's traders. See it, click it, trade it. Research with fundamentals, endless forecasts, and more. Drill into data, find opportunity, and track the action with hundreds of indicators. Track your options profit and loss history over time per symbol. Note your progress and plan your tactics with a trading journal. See probabilities, max profit, and Greeks in one click. Fund your account and start trading right in the app. The tools, the data, the knowledge. See it, click it, trade it. Join the club. Tastytrade.
What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
You can get up to $4,000 when you open and fund a new account with Tastytrade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tastytrade, make your move.
Are you on a quest for trading enlightenment? Driven by an unquenchable need to find the twin flame to your chosen strategy?
Our Where's Bat Live event is the search for trading's ultimate holy grail.
Do you have what it takes to find the elusive bat as we visit 3 cities?
Join 6 Tasty Live speakers
as they present 6 unique strategies
and 6 unique clues using games and probability
to lead to the ultimate prize. Sign up for this free event today at tastylive.com/events.
Life goes by fast, really fast. One day we're 25 and living large, and the next day we're 65 and hopefully still living large. It's the 40 years in between that are mostly a blur. When asked what they would do differently, most people confidently say, nothing. I have no regrets. As much as I want to believe them, I know better. I believe there's one common regret virtually everyone chooses not to remember. It's the taboo topic of not taking as much risk as possible every chance you get. Remember, the genesis behind Tasty Live was to encourage risk-taking. What were we thinking? Imagine the risk of building a business designed to encourage people to take risks. One of the things I've learned about taking risk, it's not personal. You can't let your ego dictate your decision-making. Unless, of course, you're the richest person in the world, then it's a death trade. Another thing about taking risks is that it's never obvious. There are no easy decisions. Risk-taking should be fun, engaging, and challenging. But if it ever seems apparent, success will not be easy. The great thing about the world of finance is that success does not require genius. In my opinion, the model for success, without a lot of complex math, is relatively straightforward. It's risk times longevity. Between academia and financial media, we have overly complicated embracing the paradox of risk. It's finally time to simplify the model behind success to risk-taking times duration. This definition should give everyone hope and a reason to hang in there.
Your crypto needs a wallet. And crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
If you missed the live show, here's our cherry on top weekly recap.
First of all, I'm sitting in the captain's seat. I've never been.
Got the need for speed? No problem. On Tastytrade, adjusting your option positions is a right click away. Rolling just got quicker. Tastytrade, make your move.
Yeah.
You're live. We'll do it live.
What's up, everybody? It is Wednesday, October 23rd, a lot of bit after 5 p.m. Central Time. That is the best time. You know what that means? It's time for Tastylive's evening show, a little podcast called The Price of Truth. My good friends. Actually, you know what? I just realized I probably got an audio issue on my end. My apologies, everybody. What a day it has been. It is Wednesday. I'm so sorry. There we go. It is Wednesday, and that means, of course, we have our extra special guest, Ilya Spivak, on with us. Ilya, how you doing, my friend?
Good. It's finally been a day where some of my thinking for stocks has started to work a bit, and started to catch up to some of what I've been thinking about for the dollar and everything else.
Yeah, we've got a lot to talk about today. Nice little sell-off in the NASDAQ. Bonds continue to move lower, yields higher. Some negative news on Apple, fairly low volume. A decent end-of-day rally. What does that mean? McDonald's, E. coli, Starbucks, not announcing guidance. You and I have a bone to pick on whether or not the dollar has increased or decreased in purchasing power since the 1970s, since leaving the gold standard in 73. We got a lot to discuss, but first and foremost, we just say what's up to the people. Shout out to everybody in the chat. Shout out to our producers as well, who did an awesome job working through some tech stuff in the background. So shout out everybody in the chat. If you could say some nice things about Laura and Paul for getting us up and running and for dealing with my lack of tech prowess. You do feel at some level, Ilya, like when you were in your young 20s, you were a tech savvy guy. People in the office, they would ask you, "Hey, how do you fix this? How do we set this up?"
Yeah.
And now I'm kind of that guy who doesn't know how to log into anything. I'm like that helpless old man. I'm a young guy.
I haven't quite gotten there yet.
You're locked out again.
I haven't gotten there yet, but I'm sure it's only a matter of time. The speed with which my kids have mastered the phone is telling me that I am days, if not hours, away from obsolescence.
At least you're self-aware. That's really what matters. Do me a favor, everybody, as you come in, a little bit of a rough start, but all's well that ends well. Do us a favor as you come in, hit the like button, subscribe to the channel if you haven't already. That's going to give you the ability to type into the chat. We're going to throw up your chat and your usernames on the screen here in just a little bit. You should be able to see them already, actually. Let's say what's up to people. Lone, what's up? Cactus Leo, H. Montero, thanks as always for being patient with us here. Space Explorer, Osborne, what's up? Steve J, V-Dub, Soul Train, Tom Cook. Any relation? Any relation, Tom? Taco, Yum, Dav, and Sleepy Mocha, so many more. Shout out to all of you. Thanks for your patience. Off and away we go, my good friend Ilya Spivak. Let's make some TV magic. What do you say, my friend?
Let's do it.
You and I were sort of debating, having a little bit of a political debate. One of our producers here in the background, I'm not going to say which one, hardcore MAGA. And so we were just kind of debating, having a friendly debate before we went on. Anyways, my friend, I kid. Though nothing wrong with it. It's funny only because that person is the exact opposite.
Is as blue can get.
Hopefully that person's chuckling to themselves behind the scenes because I'm just having a little fun. All right, Ilya, NASDAQ cash indices down about 1.5%. The Dow Jones down almost 1%. The Russell down 0.4%. The S&P down nearly a full percent. That wasn't, one part of the day, the damage actually was a lot worse than that. I would say towards the last 2 hours of trading, we sort of found a bid, NASDAQ like close to 20,000, down around 2% in the futures. You could tell there seemed to be a little bit of a pause, a little stop and reverse on a dime at 20,050. From your point of view, I almost sometimes hate to ask why. What was the catalyst in your mind that propelled us lower? Was it, negative news this morning on Apple? Did you see it as economic news, or did you just see it as a market that was, fairly heavy and looking for a reason? What do you think here, Elliot?
In my mind, it wasn't really one thing or another. There wasn't really anything in today's news flow that made you go, oh my God, sell everything. Because the sell-off was really broad-based, right? It wasn't just NASDAQ. You saw it in the S&P, you saw it in the Dow, you saw it in the Russell. You saw it all over the map. And so it wasn't the kind of thing where you went and you said, oh, well, Apple had a bad thing to say and off we go. That didn't seem to comport. Instead, I think this market has kind of been toying with this interesting idea for the past really several weeks. And I think the upshift in yields, especially at the long end that we've seen, and the upshift in the dollar kind of tell you what that story is. And stocks have had an interesting time responding. They haven't quite figured out, I think, which part of the ledger they're on. And I'll paint it like this. Since the beginning of September, before the Fed actually made its move, but in the run-up, we know markets are forward-looking. They will tend to anticipate. Since the beginning of September, especially this time around, the markets already had the cut baked in. There was some question as to whether it would be 25 or 50. The markets were heavily leaning to 50, and then the Fed delivered everything they thought. But already since the beginning of the month, as the market crystallized around its expectations, the view became we're dumping stimulus on an economy that isn't doing badly. As a matter of fact, it's growing at a very healthy clip. And what this will mean is inflation. And so inflation expectations in the bond markets went up to the highest levels since June. Gold went to record highs. The yield curve steepened to the steepest setting in about 2 years or so. So you saw this reflation narrative happen everywhere. And from stocks perspective, this is kind of a challenge. Now, for bonds, you saw very clearly, boom, yield curve steepens, long bond dumps off, 10-year note dumps off, rates go up. It's all very clear. Yield curve and Fed funds futures are telling you fewer Fed cuts for next year. They've priced out between 1 and 2 cuts already, depending on when you look. And you get a very clear sense of what's going on in the bond market. In the stock market, this is a more controversial story because on the one hand, well, it's more growth. That's good. That's earnings. That's a good story for stocks. But on the other hand, it's higher rates, which is not what stocks want. So stocks have managed to keep going higher if we look at something like the S&P, but we can see that the vigor with which bonds are going down and the vigor in the response in bonds and in the dollar to higher rates is significantly more convincing than this kind of limping along in stocks, where you're kind of trying to keep going, but the momentum is not nearly what the bonds are doing in adjusting to the same thing, not nearly what the dollar is doing in adjusting to the same thing. And it seems like maybe something gave, maybe a levy gave. Now, it's really early yet. The S&P has not overturned its up move. The NASDAQ is soggier, but only by a little. So you're not really crossing any Rubicon here yet in equities. But maybe what today was the start of this realization that a strong U.S. economy that is by far stronger than Europe, by far stronger than virtually everywhere else. In fact, the global economy has been slowing since May, whereas the U.S. economy is not. Everywhere else is in horrendous shape in relative terms, especially the Eurozone, and China has been basically at standstill for over a year. Six quarters now of deflation. So when you compare it, you say, okay, well, yes, that's good for U.S. markets. It's good for U.S. outperformance, but that also means higher interest rates for everybody. Only the U.S. can stomach it, and everybody else can't, because their growth story is very different. So if the Fed cuts less and interest rates are higher on everybody, and we can see that already because what the U.S. rates market is doing is already spilling out, because of course it is. That's the price of borrowing dollars, and global commerce runs on dollars. So what this is doing is it's bidding up borrowing costs everywhere. And the rest of the world is not in a place where they need tightening. They're in a place where they need loosening.
Mm-hmm.
So this hot U.S. economy may be finally starting to give stocks a little indigestion, because they look at this and they go, but it's good for the U.S., yes, but is this good for global growth and for the earnings of the multinational companies deriving their earnings from the world over that make up the S&P? Is that good? And I think stocks are still on the fence here, but you could make the argument both ways. And the sluggishness of the stock market tells you they're not all the way sold that what this is will be good. Because U.S. resilience, U.S. demand has mostly stayed domestic. It's not spilled over.
Let me ask a quick question to the chat before we continue our discussion, Ilya. For those that are bullish, at or near highs here, I'm just curious how you're expressing that bullish opinion. Are you long stock, but have you collared up, or you're long protection in a portfolio? Or are you long, but long like risk defined, like upside call verticals, but you're being super careful about the capital exposure? Or are you just kind of long stocks with sort of a comfort level here at 5,800? I'm just this isn't necessarily it isn't a question for the bears. It's a question more for the bulls, more for those that have positive delta exposure. I'm just curious how the chat is actually expressing that view, given given all the potential risks that are on the table, I want to continue the discussion here, Ilya. Outside of, because you brought up some great points there to sort of pull on. Before I pull on any one of those, I want to bring you into a discussion just around volatility before I then start pulling at bonds, interest rates, and sort of your narrative around equities. It's probably no surprise here. You get a little down day in the marketplace, and even though we had elevated levels of volatility, 18 and change in both VIX cash as well as VIX futures, you did see an additional reach for protection here today. So VIX cash goes up to 19 and change. We're up 5.7% in the VIX. VIX futures goes up to 19 and change as well. I'm just curious, when you look at how the market is positioned here, at elevated levels of volatility, is there a risk signal in any way that in the way that you are seeing volatility here of the S&P?
Not at these levels, I think. I think if we were to get above the range that we've been in basically since the beginning of September, top there, let's call it 21, something like that, then I think you're looking at something different. Also, the velocity with which you get there is important. So if you look at that spike at the beginning of August, what you see is that, in particular, those 2 big days of vol, before you get the really big spike, you get a very clear difference in momentum, where the rise is big in a given day. And this latest increase that we just saw in the past session, we saw something like this quite a few times over the course of the past, let's call it almost 2 months. Again, going back to the beginning of September, where the current range lines up. So I don't necessarily see that this is screaming at this point. I mean, how different is this from, let's go back 6 days, that vol pop? It's not that different in terms of its size and in terms of the levels that we're at. We're essentially back there. We've just erased 6 days of VIX action. So I'm not looking at this and saying, oh, well, this is like a giant screaming alarm at this point, which, by the way, doesn't mean that it's not going to be one tomorrow. Again, as we saw back in August, you get one day where vol noticeably picks up versus the preceding 5-6 sessions. And then the very next day, the follow through is wild. Is it possible that that's tomorrow? Why not? But it doesn't look it here yet.
Yeah, we're getting what I was able to do. I agree with you. I don't think the level of the we haven't seen a nice pop in the VIX to where I would feel comfortable selling juicy put premium. I don't think we're there yet. I did think that given the downward move that we got in the market, and though we got a pop in vol, we didn't get a disgusting pop. So today gave me a chance to buy back in some short calls. So people know that I usually put zero cost collars on, which means I sell upside calls to buy downside puts on positions, longer term positions, to minimize portfolio vol. So on days like today, it was an opportunity, at least for me, to buy in some of those upside short calls on stuff like Chinese stocks, which leaked lower. We had, but we've got long puts against that stuff. Let me pull the thread on bonds here for just a second, man. There was a great discussion, I believe it was yesterday, with Paul Tudor Jones. Before I say what the conversation was, did you see it? What's your opinion? I'm always curious. I know your opinion on like Stanley Druckenmiller, the market wizards. I know your opinion, Ira Harris. I've never asked you about Paul Tudor Jones. What's your point of view here? GOAT?
I like him.
Okay.
I like him. I think he says a lot of things that make a ton of sense. I think the insights he has about tactics, oftentimes very, very insightful. He has a technical streak that I enjoy as well. I also look at technical analysis. Granted, mine is very simplistic. I try to make mine to where you could do it with a crayon, but I do look at those things, and I do factor in some technical inputs into my thinking. So I think he's great. He was covered in one of those, maybe not Market Wizards, but certainly inside the House of Money, which is a similar interview book. I think that the one that Ira is covered in. I think he might have been in there as well.
There's a great Paul Tudor Jones is in this old school documentary. It's out there on YouTube. Yeah, when he's super young, he's flying out to like the Swiss Alps. And back then, his approach was he would use computer programs to find which periods in history their charts line up to the period that we have, and then he would use whatever happened then to predict what could potentially happen in the future. And it like to see that was sophisticated philosophy now. If you tried to do that today to overlay 2 periods of charts, everyone would laugh you out of the room. Nobody believes that's smart decision making anymore. But at the time, it gave him edge, and now he's sort of graduated in sophistication in sort of his macro approach. Anyways, in the interview, he said some of the things that we've been saying here. He said he's not long fixed income. He would not own duration, and he's actually short the back end of the curve. And in explaining why, he effectively said we're $36 trillion in debt, and we're taking in $5 trillion in revenues a year, and we're spending $7 trillion. And what looks like we're going to do that as far as the eye can see. So at 4%, for that type of trade-off, it doesn't make sense for anyone to loan the U.S. government money over a 10-year period or 30-year period with those types of dynamics in play. And so I'm curious, again, that's a familiar concept to everybody that's been watching this show, but maybe a mainstream audience, I'm not so sure. How does Ilya Spivak think about just those very simple numbers about income and revenue versus money that goes out the door, and what that proposition means for a 10-year or 30-year bond or note investor?
I mean, I think he's right in where he believes rates are going, which is structurally higher. I don't necessarily agree with why. And my narrative is otherwise. So I see structural reasons, which we've talked about, demographic changes, the exiting of baby boomers out of the labor market and the follow-on labor shortage, which is only going to be exacerbated because apparently as a bipartisan matter, we're becoming, and not just in the US, everywhere in the Western world, more circumspect of immigration. So there is less scope for immigration to cool labor shortages that are happening because of demographics. And that means higher labor costs. That means inflation. The deglobalization kick that everybody is on currently. And again, bipartisan, left, right, US, outside. That's inflationary, because the same way that globalization getting deeper lowers transaction costs to business and is disinflationary, more trade barriers makes doing business more expensive. That's inflationary. The price of everything goes up. All of those things are why inflation is going to be structurally higher. Rates will have to be structurally higher. I think when you consider the U.S. debt situation, I think you have to have basically 2 ideas in mind. Number one, there is no question that the U.S. is on an unsustainable fiscal trajectory long term, and that needs fixing. I think that much is clear. And the numbers that he cites, they are what they are. Clearly. I think the larger question you have to think about in terms of making an investable, actionable thesis out of that idea is that debt is not about aggregates. It is about the ability to pay. Bill Gates can borrow a lot of money, and just because it's a lot doesn't mean he can't service that debt, because Bill Gates has a lot of money. It's not about how much debt you have. It's can you pay down the debt? That determines whether you're going to see a rise in borrowing costs in response to all of your borrowing, because that rise in borrowing costs, what does that mean? It means the more you borrow, the greater the risk that you don't pay. That's how the market tells you you're borrowing too much. It raises interest rates on you. The idea that there is a more eligible borrower than the US government is ludicrous. Not only is it ludicrous because the dollar is unchallenged in its role as global medium of commercial exchange. So there is no constituency to default on the US because that would crash the global economy for everyone. Even countries that are unfriendly. Even those countries are not a constituency for this. But also, even just in absolute terms, where does the market discipline come from when the US is sitting on the biggest economy, the richest tax base, the strongest military with which to compel adherence to its interests? Who is a more eligible borrower? Not a perfect borrower, but a more eligible borrower. Who is a safer entity to lend money to? No one. Full stop. And as long as that's the case,
question, though. It's not a question. It's not a binary question, right? It's not default or not default.
You're absolutely. So
we're talking about how do you price the risk, and if the risk is getting elevated, even if you feel the chance is remote, then you need to price that risk in the market. And I think what was really interesting about the interview is he pondered aloud whether or not the election and the clarity of the election would force a Minsky moment.
Yes.
A Minsky moment effectively saying that the bond market or long end of the yield curve was going to now perhaps show what would be a more realistic price of long-term U.S. debt given our current fiscal situation and our unlikely plan. We don't have plans to do anything about it or get out of $2 trillion deficits.
Not in the current election anyway.
So the short-term tradable concept that I wanted to specifically bring this up was, how do you think about the idea that getting through an election could potentially lead to a Minsky moment in the long end of the curve where we go find a real price on U.S. debt instruments or long-term U.S. debt? Maybe that's 5%, maybe that's something else. What do you think about that?
Well, so this is why I went down the road that I went down. Again, I do think he's right to say that yields are probably going higher. Certainly the fact that there are no fiscal austerity options on the menu in this election feeds into that idea more as a near-term story than even the longer-term dynamics. Again, where I don't agree is if you thought that the fiscal situation now means the U.S. is a greater credit risk, even incrementally, that's where you would think it would show up in yields. And I don't think that's the case. I don't think the U.S. is any more or less of a credit risk as a near-term consideration because none of the realities that make it the most eligible borrower have changed. Having said that, nobody can predict what happens 20, 30, 50, 100 years from now, and the trajectory, if it continues in perpetuity, is unsustainable. So this is a 10-year conversation. It's not a tradable yields now conversation. But do yields go higher from here because we're in a structurally inflationary environment probably for the next few decades, including right now? And is that exacerbated near term by the passing of the election where everybody goes, right, so no matter who wins, we end up with bigger deficits. Bigger deficits means a hotter economy. A hotter economy means inflation. Inflation means higher Fed rates. At what you don't have to start thinking about such lofty things as the U.S. becoming a less eligible borrower, which I think is nonsensical as a near term kind of within the tradable horizon idea to think that yields are going higher. I think with the certainty of the election outcome, no matter who wins, you go, right, so debt financed inflation and higher rates. That's where we're going. That doesn't matter. It doesn't matter who it is at this point.
Yeah, I think there's some possibility. I don't love the price. So we went from 127 to 117, and there's some part of me that thinks that there's a mechanism by which to tell the president, the new president, how much the bond market is going to accept. So if you want to tell the president, like, of all those promises you made, whether it's 7 trillion or 8 trillion or 4 trillion or whatever, this is what you can get off. And the way you do that is by showing what that long term, by moving the 10-year and the 30-year. And that paper is not held by a big group. It's held by a relatively small group of people, both domestically and foreign, in the foreign market. So some part of me goes, I kind of like the idea of low probability payouts post-election on even higher rates. I don't want to spend a lot of money on those bets, and if I'm wrong, I want them to expire worthless. But there's a part of me, and I already started to ladder into this in sort of the December timeframe, that just some really dumb, low probability but high payout trades that says, if you get an election and then 2 days later, November 7th, I think the Fed meeting, you get a 25 basis point cut, and you aggravate the long end even more, that we could be setting up for a situation where we're already at 425, you just aggravate the long end a little bit higher, and the bond market makes itself known when it comes to like setting policy for the next 4 years. There's some part of me that likes that trade.
I can totally see that. I mean, obviously I am on the train of higher U.S. yields, because what is higher U.S. yields, right? It's money that costs more. Not surprisingly, the dollar goes higher in those environments, or tends to, unless, of course, because the dollar is special, it goes up because everybody's running away and going to cash. That's obviously not this environment here. This is a reflation, gasoline on a fire kind of environment. And so I can absolutely see that, and I am trading it accordingly because I am massively long dollars. And that's sort of the way that I'm expressing it. I sort of bungled my attempt to do it through TLT. It kind of tossed me around a little bit when we got that wiggle up at the beginning of
last week.
Yeah, I traded it all. So I bought a put, and then I got out and flipped it, and then I got out and flipped it again. Terrible.
Yeah, but that's what happens to.
I am deeply unhappy with the way that I broke all of my rules in the trading of TLT. But at least the dollar is working, and that's right. I've participated that way.
Your style works really well in trending markets, so you hold on a lot longer than I do. I might catch some tops or some turns, but I don't hold on for the length of the move the way your style allows you to. So I don't know,
I'm looking now for the bonds to bounce a little, because they feel like in the very near term they're maybe a little extended, even just over the course of a couple days, to backfill to around 119. Let's say, on ZB, just a little retest, and I'm going to be looking to sell.
Yeah, it's such a bummer. I played that well and just got out of that trade too early, and I've been praying for a rally in bonds, not because I believe they should rally, but just to let me get back into the short side of the trade.
Just let me sell something. Just let me sell something.
But I put some stuff on. I did end up putting some stuff on in the 10-year today on a post-election. I think I laddered some Novembers and some Decembers. But let's talk. Oh, real quick. Let's talk Tesla just for a second. You and I normally don't talk individual stocks, but I do think this is relevant. They had earnings after the close,
Mm-hmm.
and we had a massive jump here. So we closed somewhere around 212,
I mean,
and
they
we're
beat
now,
by a good
we're trading up near 240. I mean, they smashed their estimates.
Yeah.
Your thoughts, given the fact that we've got sort of this downward pressure on beta today, your thoughts on, big Mag 7 like names in Tesla coming out doing something like this? Do you think this perhaps mutes the downside momentum for going into tomorrow?
Maybe. Probably not for any sort of a lasting move, but obviously this was very emphatic, and obviously Tesla is a big part of the overall kind of tech super glide hopium story. And so I think that could give you some opening dynamism. I think what's interesting here, if you look at what's going on now, I mean, this is sort of the beauty of futures markets. You can see what sentiment looks like before the cash equity open, and it's not looking great. I mean, yeah, you got a little bit of a gap open for the futures overnight, but if you look at how they've performed since then, they're not really running away. You should be seeing them perhaps participate and have a little bit of a Tesla bump in them. Not there. So maybe this is low liquidity yet. Maybe we're not really into the sort of meat of APAC liquidity here yet. Maybe that's what this is. Might be early yet. We'll see what London does with it. That's a much more liquid market in general. But if Tesla's previous lagging over the past several months before it really started to come back around a little, if that didn't stop the NASDAQ powering higher, it really shouldn't work the other way around either in a lasting way. I would think that it could give the NASDAQ some support maybe at the open as people essentially take stock of what happened overnight. But if we don't get a meaningful lift to Europe, even just to NASDAQ futures in European hours, let's say, it's probably not a whole lot there.
Two things here. One, that this Tesla move, at least for now, right? Knock on wood. Who knows where we open, but at least for now, this move is much, much greater than what the option implied move was. I think the implied move was like $13.
Yeah.
So right now, this is an outlier move in Tesla, and I think just the fact that we are seeing the potential to see outlier upside moves on Mag 7 stocks that have already had pretty big moves. This might be an exception, right? Because Tesla had sold off a bit off its highs of 240 or 250. So who knows? I'm hoping it stays because I had a 240, 250 call spread, but some stupid out of the money call spread, I think, before the robo-taxi event, something like that, and I held it. So it's actually going to make a little money tomorrow. Knock on wood. We'll see where we open. One more for you. Stock story before we get macro again. I want to talk dollar in just a second. But yesterday, McDonald's had this, pretty decent discount priced in at $2.82.
Sure.
Chris and I made this joke. I basically said, by tomorrow's open, this thing will be back to 300. There's one thing you'd never do, man, and that's panic sell an E. coli story on a fast food chain. Like, if there's ever been a story that is recoverable, it's like, it's gross as it sounds, man. I tweeted this out, but Chipotle had rats falling out of the ceiling 2 days after a norovirus outbreak that hurt, I think, 135 customers, which was a year and a half after a E. coli, salmonella, and norovirus outbreak countrywide. And that stock, within a year, I think split adjusted had gone from 10 $10 at the beginning of July to like $6.50 off all this bad news. And a year later, it had recovered, and now it's trading 10 times more than where it was right now at that point. Anyways, when you see stuff like this, do you just look at it as opportunities to build short-term positions and stuff like this, or do you not trade that way? You're more stay macro.
First question that I had was, do they have a geographic area for this E. coli outbreak, and does that have any synthesis with anything else in the news?
He never touched it with the human hand.
In fact, he gave a whole speech about how
that was such a
you don't
great
have
line.
to touch it because you
Never
could use a
touches the
scooper.
human hand. I thought that was the
He
greatest
gave a whole
line.
speech about it. Hilarious. Hilarious. The truth is stranger than fiction recently. That these two stories happen at the same time is just chef's kiss. But when you look at this, I mean, this is McDonald's. An E. coli outbreak is going to radically upset the long-term trajectory for an iconic American brand that is that everybody is bought into, and that is a cultural fixture, whether you eat there or not. No.
I agree. I couldn't buy it. I wanted to buy it in the extended hours. I tweeted. Chris and I were going back and forth, and I go, "This thing will be 300 by tomorrow." It's so funny, and it closed the day at 298.50. Let's get back on the macro side of things. I'm going to give you a pick 'em. Crude oil or natty gas. And the reason I'm putting natty gas there is because this thing has been an absolute awful trade for like weeks in a row. And Chris and I were flirting with the idea of selling puts yesterday. I didn't get them off. I tried to buy calls, but the market was already closed. It was like after 4, so we were in the in between session. But we can go natural gas, we can go crude. Which one?
So, I mean, we can do both because I don't really have a strong opinion on nat gas. I've taken to calling it the Leroy Jenkins of markets. It just runs where it wants to go. There's without any apparent rhyme or reason that I can discern from a macro perspective. It seems to come down more to kind of the nitty gritty of the nat gas market. And that's not really the way I think about things. So I've taken.
In other words, there's way more idiosyncratic movements here versus the more correlated macro point of view that you typically trade on.
Yeah. So I look at this and I say, okay, well, it was down a lot that it bounced a little.
All right. Crude oil at 71.10. What do I do here? What do I need to know?
This I think is very interesting. If you look at where you might have anticipated this to be, were you to have looked at gold, you would have said, oh, geopolitical risk. This is all very scary, and Israel is going to retaliate against Iran any day now. And who knows what they're going to do. And there's live risk here because although it all looks like theater and it all looks like, okay, they're not going to hit nuclear sites, they're not going to hit obviously civilian sites, that was never a conversation, that they're going to also not hit any oil infrastructure, that they're going to keep it to military targets, and ostensibly they got a U.S. THAAD battery to kind of sweeten the deal out of it to not escalate any further. So their deterrence is bolstered even without them having to go do something huge. They get a little added piece to their deterrence, not only because they get more missile defense, they also get a bunch of U.S. servicemen now in between them and Iran. So if Iran wants to shoot at Israel, now there's U.S. servicemen in the way. That's a big deterrent already. So it looks like this is not going to be a big deal, but it's missiles. They sometimes hit the wrong stuff, and wars happen even if nobody wants them. So you get into a situation where you look at gold and go, well, that's obviously what it is, because why else is gold rallying when the dollar is up and yields are up? But then you look at crude and you go, nope, that can't be, because this thing attempted a bit of a bounce and got stuck at that axis at 72 that it's been oscillating around since early June. That thing was about support, give or take a few bucks. Then it became just this oscillation axis where you hit it, you come off a little bit. If you push through, it keeps going. If you go under, it keeps going. And so in my mind, what we've just seen is a bit of a bounce to retest that area again and essentially to touch that gap that took us through that area, about 2 weeks back, 2.5. So I'm bearish here. Bearish crude oil. I'm not very bearish. I have a little USO put vertical basically around here, looking to come back in into the swing lows we saw in October, September. Largely because I think this is the story of geopolitics risk in their potential, and every time the potential isn't realized, it fades again because the actual supply-demand story is overwhelmingly against it. Demand estimates keep coming down. Supply is the biggest it's ever been. The U.S. is at this point, never mind that it's producing a record amount of petroleum. The U.S. is now producing more petroleum than Russia and Saudi combined. So, and I mean, again, look then what the election means for this. Nothing. Both of these candidates are for lots and lots of U.S. energy. So, supply is awash out there, and demand is weakening. Apparently, if you look at the latest estimates from the EIA and from OPEC and from the IAE, then you look at all of that together and you say, well, the only thing that's giving this any manner of elevation is the potential for geopolitical shenanigans. And when the potential eases, this thing comes back down. Now, if it goes over 72 in earnest, I'm going to run away and say I was wrong on the price.
That's interesting. You trade like to the penny, because if I looked at 72 and I saw that as sort of its potential axis, but then I also see that I've probably got some risk up to 76, then I start layering into a small position at 72. I fire again at 74. I get max position size at 76. And then if it breaks my sort of that upside range, then I'm out. So you and I are the way you trade is really interesting. You're to the penny. Yeah.
But not quite, because obviously support and resistance.
You get what I'm saying.
Yeah, but support and resistance is never a level.
And you commit to that range.
Yeah.
Whereas I scale.
Right. So I will look at I would look at a crude oil chart here and basically say your broad range for resistance is, let's say, 70, 80 to 72. And as long as you stay pinned underneath that, it's bearish. And if you get over 72 and you end up at, let's say, 72.50, 72.80, that's not the trade that I took anymore. That's not you run out of steam at 72. So I'll get out there, wait for a new sell signal, wait to make a new lower low, and go again.
Right. That's beautiful. All right, man. I appreciate you. Let me walk around inside your mind for a second. Very clearly articulated. Let me ask you this. I'm going to start with my end question. So I'm going to tell you where I want to go, and then I'm going to give you the setup.
Okay.
The ending question of where I want to go is silver just took a really big haircut today. I think we're down 3% or something like this. Yeah. And so my ending question is the discount that we just got in silver a discount? Is it time to go shopping in some of the metals, silver, particularly given the discount we got today, if you have no exposure or wanted more? And the setup is, tell me what you think about the dollar, and you understand why that's the setup, because I want to know not only your point of view on the dollar, but then how that impacts your point of view on whether or not today is a sale or whether it's something to be a bit more cautious about in the metals.
So you've followed the way that my mind works about this in the construction of your question, basically step for step. I look at what happened in both gold and silver over the course of everything, let's call it a week's worth of price action, 2 weeks worth of price action. Going into today, but before today, and I go, what in the world are you doing going higher when yields are going up and the dollar is going up? What are you doing? This is kryptonite for you. You all don't yield anything. You are the natural sort of physical store of value foil to paper currency. You trade inversely of the dollar and of yields. The worst possible thing for you is when the dollar and yields are going up at the same time. This is like precious metals Armageddon. What are you doing going up? And frankly, I could not make sense of it. So I was looking at it and going, okay, well, the only thing that I can possibly kind of construct in my mind is that we're sort of back to where we were late 2023, early 2024, where gold, again, was completely ignoring everything. And then when we looked at Chinese reserve buying, all of a sudden everything made sense. There was a non-economic, non-macro-minded buyer out there buying at a very, very rapid rate. And that has since essentially closed up shop for a while. If you were to tell me in a couple weeks' time,
they were selling bonds during that period too. Selling bonds and buying gold. Just putting that out there. Okay, go ahead. Sorry.
They're not exactly.
I don't want to take you off track.
Yeah, yeah. This doesn't matter. But it doesn't matter that they're selling bonds. I mean, they've been diluting their bond holdings for a while. So that part of it had been going on. The buying gold at that kind of speed, like 11% year on year, which is just bonkers. That's new or was new. And they sort of closed up shop on the gold buying somewhere sort of closer to mid-year. If you told me that in 2-3 weeks' time, we're going to get new updated FX reserves data out of China, and it's going to show us they started buying gold again in size, that would make this make sense. Would they perhaps want to do that for optics because they're at this BRICS summit in Russia right now, and the whole object of this is the delusional fantasy that they're going to build an alternative payments system outside the dollar? And I say delusional because they don't have remotely the volume to put through it to make it make sense. Besides the fact that China is dependent on U.S. demand and would never do such a thing, because it would mean that they would have to choose Russia over the U.S., and they're not so stupid as to shoot themselves in the face to that extent. They understand where demand is. It's not in Russia. So the optics of this maybe could be, what China is developing already, this alternative payments system. So is Russia, but China's is the one that matters. And the yuan is not internationally convertible. So one way you could get countries to participate in this settlement system is you could tell them all of your transactions are backed by gold. Not the yuan in total, but just the transactions in this thing are backed by gold convertibility. So if you get stuck with yuan, you can't take offshore. As a consequence of transacting in this system, fear not, gold is convertible. There you go. So don't be scared. Join this thing. and take yourself out of the dollar-based world. It's not going to work. And the reason it's not going to work is because the liquidity and the volumes are not there. But it is a very useful fiction for Beijing to perpetuate, because Russia, by virtue of sanctions, has to believe that vision. And Beijing really likes discounted oil. That's why it is the number one buyer of Iranian crude, which is under sanctions, that it can buy at about a 30% discount. That's why it likes Russian crude, which is under sanctions, that it can buy at a steep discount. So it has to perpetuate this idea that this is feasible and that they'll lean in on this whole thing because they have to keep the illusion that keeps the cheap crude coming alive. So maybe this is optics for the BRICS summit. I don't know, and we won't know. But it doesn't make sense that gold was rallying when the dollar was up and yields were up, which then makes this sell-off that we see today a little bit suspect. Because if you can't understand why it was going up, then you don't really have a good answer why it suddenly started to come down. And you're taken to the price action. And I think the price action basically says it. If you look at a daily chart of gold, what you see is obviously a very ugly day, but you're still in a series of higher highs and higher lows. You can't sell that. You don't have confirmation, in my mind. Now, if you got me under that swing high that we got in late September, you will have set a lower low. You will have taken out a former high, which was broken through and would now be overtaken back on the downside. There is a trend change there. And if it happened in conjunction with yields going still higher, if it happened in conjunction with the dollar going still higher, you'd get a sense of, okay, this is making some sense. I get what's going on here. Otherwise, how are you betting against something if you don't understand what it is you're betting against? China might lean into this thing in the next few days and you'd get run over for reasons you don't understand. Same thing in silver, only in silver it's even more dramatic. Silver has pulled back squarely to the top of the range that it's just taken out in the past several days. There is that range that those tops around 32.5, something like that. The range from back in May through the beginning of October. All you've done here is you've basically retraced back toward the top of that range, this time from the top side, retesting it as support. You might even dip down into 32 here and change nothing. If you break back into that range, okay, yes, then you've set a lower low. And again, if it happens for reasons that make some sense, okay, cool. That's understandable. But if I'm going to take a bet on metals coming down for reasons that make sense, I bet that through the dollar continuing to go higher, because that's been responsive to yields and to catalysts that are logical. And this has been, frankly, acting drunk.
So let me make sure I'm understanding what you're saying. What you're saying is, normally what you would do is you would probably be long the dollar, and then along with that you would be likely to be short dollar denominated commodities like gold and like silver. But you're noticing a breakdown in the correlation of those trades. So you're more comfortable being long dollars, but you are cautious about trading the short side of metals just because the dollar is stronger. And the reason for that is you feel there's something at play here, whether that's central banks buying up these metals. There's something else in play that's breaking down that normal longer term correlation. So then take me straight. If you don't have a strong opinion on the metals, then you'd be more likely to be short, but you don't have a strong opinion. I personally, just for the audience, I bought I use today as an opportunity to buy some upside in silver. And here's my thinking. I did it risk defined, as I always do in silver. My thinking was, if we break down through 32, 33, 32, this could get ugly, and it could get ugly quick, because that's how silver trades. It's got nasty beta behind it. But if we're coming down and we retest this level, and the market wants to hold, it could, I think we could get some confidence here in this market. We could resume our upside trend. So I'm using this nasty 3% down day as an opportunity to buy a little bit of upside in silver, but stay risk defined. And I'm wrong. I'm going to lose out on the upside call spread that I had coming into this rally, and I'm going to lose out on the ones that I put on yesterday when I told you guys about sort of a call spread and an out of the money call, a long call spread, an out of the money call spread, basically a calendar to make it cheaper, and then I put an upside call today. Anyways, that's my positioning. So then talk me through your positioning on the dollar. How should we be thinking about these individual crosses, man? Where's the opportunity, Ilya? And let's do this inside of 5 minutes. I'm going to leave the last 10 minutes to go back to our purchasing power discussion from last week.
Yes.
The people have been waiting for it.
The dollar worries me here because it's worked really well. And I am, of course, immediately paranoid that I'm going to give away some of these gains.
Spoken like a true trader.
Right. Like,
never nervous when it's going against you, only nervous when it's going in your favor.
By far, I'm not nervous if it's going against me. In fact, even if it stops me out, I'm like, well, good. My stops worked. This is what's supposed to happen. Next move. That's fine. But when something works explosively like this, I mean, I was short euro from above 111.
Yeah.
So when something works explosively like this, and I mean, we talked about this for the past 2 weeks, I loaded the boat with dollars. I was short euro, pound, Canadian dollar. In my spot account, I was short the Swiss franc, the Kiwi dollar, because there's not liquid futures on those things. So I had to do it in spot. But I mean, I bought all the dollars that there was to buy. And
by the way, kudos to you, because this Sunday on First Call, you could have, anyone that looks at the chart could say, we look like we might be getting to an area of support. No. I don't know that I want to press, but on First Call, you go long dollars again into this week. And both Tom and I were like, whoa. And you got the move in your favor this week. So ballsy call.
So far.
Kudos. Yeah.
So far. But I am deeply, deeply nervous because it's worked really well.
So what do you do? What do you do here?
I don't do anything. I stay out of my own way. So I think it's gone a long way. Has it been more oversold before? Yes. You can look at momentum indicators, even simple ones like RSI, and essentially get the sense of we've pulled the rubber band further apart than this, even in some recent history. So could it keep going? Of course it can. I am very much of the belief that the market could care less for these nebulous concepts like overbought and oversold, that there is no such thing, that the market is going to go exactly as far as it wants to go and not a tick higher and not a tick lower. And there is nothing in the world that says just because we've gone up a lot, we can't keep going up a lot. And just because we've gone down a lot, we can't keep going down a lot. The market is going to do what it's going to do. So I look at the near-term price action and say the dollar is still rallying. Show me that it's not rallying, and I'll get out. I'm not adding on, even as it keeps making lower lows. I've added on about halfway through. I took the Canadian dollar off about halfway through because it seemed to stall. And I doubled down on the euro, the pound, and the Aussie about midway into the run, so about a week ago. And at this point, my hands are off the wheel. And I'm watching nervously for a sign that we've set a higher low. And if we did, if there is a turn, and it takes us back over a level of support that it recently cleared, which if we looked at the euro right now, by way of reference, if we hold here at about 107.50, 107.80, and we find ourselves back over 108, I'm probably out. Because if we're back into that area of, let's call it 108.30, 108.40, where that bounce was at the beginning of this week, end of last week, that kind of wiggle, then something is different. And I'm just going to take my money and back up. But so far, it doesn't look like there's a reason to do that. And the other thing I'm watching very closely, because this is very clearly, in my mind, a function of the bonds, I'm watching if the bonds start to.
That's actually what I was going to ask you. What's the catalyst here? Is this
higher rates?
It's the yield differential more than it is. Because I was just looking at, okay, September 27th, this thing starts to strengthen against the euro, and I'm guessing the other dates are fairly similar. But there wasn't like an initial move in the bonds until maybe a week later. So I'm just curious, and I think there was maybe some ECB activity, stuff like that around that time. So from your standpoint, this is yield differential driven.
Yeah, I mean, I think if you look at where the move in the dollar really starts in earnest, I mean, the big leg, I mean, it starts to top by late August, the euro, and then it sort of wiggles around, and the peak in the euro is September 25th, maybe, but that's just the absolute high. It's already bumping around the top that it's trying to carve out there on the 17th, 18th, and that's Fed Day.
Yeah,
and bonds, they turn right there.
Got it. Well,
So
let me ask you this.
The euro basically runs into a wall the same time that the bonds top and roll over. And that's the Fed.
One more quick question before we go to purchasing power. And so producers, if we could just sort of get ready. I think Ilya's got 4 images he might want to show here. And now I'm going to forget my question. Yield differentials. Oh, where I'm going is the narrative in the market right now, Ilya, and you spoke to this early, but I'm coming full circle purposefully to tie it all into this discussion.
Sure.
The narrative right now is reflation.
Yes.
It's the narrative focus is on inflation and reflation. But to your point that you're pointing out here, higher yields and a stronger dollar, it doesn't seem like many people are really thinking through what does that actually mean to that whole reflation narrative or the inflation narrative. Can you speak to why you feel like the market narrative is still stuck in one gear while the dollar and yields are telling
it's the same gear,
perhaps an opposite story?
It's the same gear. Markets are forward looking. Markets do not care about inflation as a risk to the dollar because they understand that there is a reaction function to inflation. Before inflation could ever dilute the value of the dollar, which is a long-term sort of thing, inflation slowly eating away at purchasing power over a long period of time, if left unchecked. They understand that there's a central bank, that this central bank has an inflation mandate, that its reaction function is month to month or 5 to 6 weeks increments between meetings. So when the market sees inflation, it doesn't say, oh no, cheap currency. It says, oh no, interest rate hikes. In response, the market is responding to reflation by saying yields will be higher, as in rate cuts will be fewer, as in the dollar's yield advantage is growing against those currencies where the economy is in tatters and rate cuts are coming in a hurry, like the euro area. So this is not the inflation here is not being interpreted as dollar negative. It is rightly being interpreted as a catalyst for Fed policy to be less dovish.
Right. My point is, I get what you're saying. My point is the reflexivity of that. So once the market is forward looking and interprets that, well, now you have higher interest rates and a stronger dollar, which then reflexively means you must reevaluate what that future looks like. So I'm speaking to like the reflexivity.
Yes. Oh, no. So the market is ever forward looking. So once its initial assessment bears outcomes, and then those outcomes start to reverberate. If those outcomes then give you the flip side, well, then the markets have to look forward again.
That's right. That's my point.
Absolutely.
So let's do this. Last week, I wish I had a clip, then I would just play the clip. Last week, you said something that I think it made me scratch my head. But I've been around you long enough that I know you're a brilliant guy, and in many respects, you've forgotten more than I've learned in some of this subject. So I asked a few questions. Your statement was that the purchasing power of the dollar has risen since we left the gold standard in 73, which is sort of just counter to the orthodoxy belief system out there, to my point of view, but I might have been in the wrong bubble. So we didn't have enough time to unpack that. I'm only giving you 6 minutes, and you probably need more time. So we got 6 minutes. I think you got 4 images. So speak to this concept. Ilya Spivak, make your case that the dollar has actually strengthened in purchasing power since we left the gold standard in 1973. Do your thing, man.
All right. So look on the screen, and Laura, in the background there, I'm going to call out to switch images, and it's going to be fairly quick because, of course, I have all the time in the world to make this explanation. So what you see here on the bottom of the chart, but by the way, you're looking at two lines that are very clearly perfect inverses of each other. I mean, that much you can tell with the naked eye. On the bottom, what you see is something called the purchasing power of the consumer dollar in the US. And much of our conversation from last week said, well, that thing is pointed down. Doesn't that mean that the power of the dollar to consume is down? And my point was pish posh. That's not at all what that means. But I couldn't articulate it because I didn't have the evidence. I just knew that it was wrong. But now I have the evidence to show it.
Which one of these lines? Sorry, man, I'm having a hard time. So the red line is what?
The red line is just CPI, U.S. inflation, year on year.
Okay.
The blue line is purchasing power of the consumer dollar, year on year.
Okay, but these are just rate of changes, though, on a year-over-year basis. This isn't cumulative in any way.
No, year on year. Notice that they are the same line, just upside down.
Okay.
What you are watching then, when you say power of the consumer dollar, you're just looking at the price level upside down. You're looking at the price of goods relative to the dollar. And obviously, the price of goods is going up. We have a central bank that targets 2% inflation. It doesn't target zero inflation. It doesn't target negative inflation. It targets 2% inflation.
Right.
So what you see on your chart is in the 1980s, you see a big decline in inflation. That's Volcker crushing inflation. So you see the red line come down, the blue line comes up. You then, until COVID, see stability. You're oscillating in a range, both on CPI and on inverse CPI, which is what this really is, because the central bank is succeeding in keeping inflation positive but stable. Fast forward to 2020, you of course get an inflationary shock from COVID. Red line goes up, blue line comes down, and then you get the central bank response. Red line comes down, blue line comes up. We're back to norms on both, give or take, relative to history, going all the way back to the Volcker and before period of time. Next chart. So here, when you get the next image here, you see that same blue line, year on year change in that same index, upside down inflation, supposedly the purchasing power of the dollar.
Okay.
And then the other lines that you see there are the actual index of the dollar's value from the Fed. The red one is nominal. The green one is adjusted for inflation. So it's real. The thing to notice here is note how they are not lining up at all. And there are periods there where the dollar's value is growing aggressively, but purchasing power is not responding. So 2014 to 2016, say, there are periods where the dollar is falling aggressively, but this purchasing power index isn't responding. 2018 to 2010 to 2011. There are periods, most recently, call it 2021, 2022, where you see the blue line is going down. So ostensibly, the purchasing power of the dollar is deteriorating, but the actual value of the dollar is surging. Needless to say, this index tells you absolutely nothing about what the dollar's value actually is or what it's doing. All it's telling you is what's happening to the price level relative to a single dollar. It's just upside down CPI. Whereas the value of the dollar is measured in terms of its purchasing power of other currencies. Because that's the only way you can actually value a currency, is in terms of its purchasing power relative to another. And so what you see here, next chart, is I've made things even more straightforward, and I've taken the year-on-year change off of this. So what you see now is just the absolute index in the blue. That's, again, upside down CPI. If you put CPI here, it would be the polar opposite thing going in the upper direction. So ostensibly, this is telling you that as the purchasing power of the consumer dollar is declining, the dollar's value is rising through that entire period. Look at the uptrend here since 08 and on. Unfortunately, Fred didn't have data here that was older than 2005. I wanted to go back further. But even just conceptually, what you see here is the dollar is going up in value this entire time. That the other line is ostensibly telling you its purchasing power is weakening. That doesn't make any sense. That's because the other index, again, is not measuring the dollar's purchasing power. All it's doing is relating a dollar to goods, and the price of goods is rising because inflation is positive as the Fed intends. Last chart. Here is the punchline, and I realize that this chart is a little bit messy. But consider, for example, the extreme case of 1980. Consider all of, in fact, the shaded gray areas. All those shaded gray areas are recessions. The green line here is real GDP per capita. Not just aggregate, but per person in the US. Notice that in every period that's gray here, every time you have a recession, the green line drops below zero. Obviously, it's a recession. Income per capita is declining. And yet, in an overwhelming majority of those periods, the supposed purchasing power of the consumer dollar rises. How is that? How does that make any sense? If only to say that that's not the value of the consumer dollar. That's just inflation falling. Because in an economic downturn, there is less demand, there is less pressure on prices. That's just cooler inflation. And if you look at the purple line, which is inflation, you see exactly that's what's occurring. Look at the recessions in the 1980s. Inflation down, output per capita, GDP per capita by another name, that's also down. Is that telling you that in a recession, a U.S. consumer is better off because their dollar is stronger? Nonsense. That's not at all what that's telling you. Notice also the red line, which is year-on-year population growth, is always above zero. So demand, just demographically, is always growing because there's more people. And that's keeping inflation moderately positive. The Fed's job is not to let it get too positive, but also not to let it get too negative. So that purchasing power of the dollar index, which is again inflation upside down, a point I will continue to make, is all that's telling you is inflation is positive. That's it. It's not telling you anything else. Whereas the dollar itself, at least since 2008, has been going higher and higher and higher.
My friend.
Your floor.
In 10 minutes, you were able to plead your case. Because we are over the mark, I'm gonna do something kind of fun. I'm gonna just open the floor to the audience. I'm gonna ask the audience in the last 10 minutes. Ilya has made his case, and in the comment section of this video, I want to know if he convinced you or not, and if not, put your reasons why, and we'll make this a 3-part episode. The first part was your premise, the second part was your explanation, and the third part next week is going to be you defending the position against both my critique and the audience comment critique. You down with that?
Sure.
Who knew that simple statement you made was going to turn into a 3-part mini-series here on Tasty Live? Ilya Spivak and the people want more from you, and they definitely should. Tell them where they can go.
As ever, I'm all over the Tasty Live network. In fact, I'm doing an extra Futures Power Hour now on Mondays with Chris. I'm on that Mondays and Fridays. I'm on Overtime and Macro Money Monday through Thursday. I'm here on Wednesdays. You and I are both with Tom for First Call on Sundays. I'm writing for the News and Insights portion of tastylive.com. I'm commenting every now and again on the former Twitter machine at Ilya Spivak, and anywhere else that will stick a microphone in front of my face.
My man. Ilya, thanks for all the work you put into putting together those images in this conversation and the work that you do here at Tasty every single day. You're a gentleman, a scholar. It's always a great conversation. I learn a ton every time you open your mouth. For everybody out there, if you haven't hit the like button already, do us a favor and do so. Subscribe to the channel. And this one, light up the comment section, not the chat, but the actual comment section under the video.
And bring reasons. Don't just say it's wrong. Say why. I want to know why.
Hey, trust me.
I need something to argue against.
Trust me. I'm telling you, the comment section in here, they bring receipts, so they'll tell you. I'll see you back here. It's moving day tomorrow, so a little touch and go. But I will see you back here, everybody. Next week, I'm going to be off as a reminder. I'll be traveling and off in a land far, far away. But I look forward to seeing you all very soon. Same time, same place, right here on Tasty Live. Until then, peace.
Peace.